In 2012, Warren Buffett claimed if he could snap his fingers and buy a couple 100,000 single-family homes, he'd do it in a heartbeat. Today, his outlook is more cautious. He points to a metric showing the unique conditions that once made real estate a screaming buy have shifted, making the current logistics of the asset class much harder to justify. We are often taught to view physical property as the ultimate safe harbor, a tangible, reliable place to build wealth that we can see and touch. Buffett identifies a massive hurdle in distressed real estate, the friction of the transaction itself. Acquiring these properties involves negotiating with multiple equity holders, satisfying lenders, and navigating a mountain of paperwork. Because every single sentence in a real estate contract must be painstakingly negotiated, buying physical assets at scale is a slow and difficult process. This contrasts sharply with the security market, where the volume of opportunity is vastly greater. On the New York Stock Exchange, an investor can execute billions of dollars in business completely anonymously in a single afternoon. Massive trades are completed with absolute speed. If the price is right, a deal involving thousands of shares is finished in exactly 5 seconds. Charlie Munger actually enjoyed the complex game of real estate negotiation. Even so, he admitted he would still choose stocks every time for their sheer ease of execution. Physical property requires multi-phase negotiations that can drag on for months. In the stock market, the transaction is immediate. By removing the human friction of negotiation, the stock market creates an entirely different environment for generating wealth. The core of this system is liquidity, the measurement of how fast an asset can be bought or sold. In the modern market, liquidity is absolute. There is no waiting period or physical paperwork. An investor simply taps a screen and the trade is complete. This effortless accessibility creates a behavioral paradox. When trading becomes this easy, people often bypass critical thinking and revert to emotional reactions. A family will not panic sell their physical home just because they read a negative news headline at breakfast. However, a stock trader can dump their entire portfolio in seconds over that exact same headline. Maximum convenience creates a volatile system driven by knee-jerk human emotion rather than logic. Buffett's philosophy is that the market is driven by mood, not math. This mood-driven environment causes wild price swings, even when the underlying value of the business remains unchanged. The chart from March 2020 shows this visceral panic in action, falling 34% in 3 weeks. We saw a similar collapse in December 2018, dropping 20% in 3 months. By 2022, the Nasdaq fell another 33%. These crashes are recurring events that happen like clockwork every few years. The hyperliquidity of the stock market reliably manufactures massive discounts that slow physical markets cannot produce. While the overall market is volatile, individual stocks experience even more extreme, irrational price swings. In early 2016, Apple reported its first ever drop in iPhone sales, triggering a wave of fear. Wall Street analysts immediately slashed their targets, and headlines claimed a company had reached its end. This emotional contagion caused Apple's stock to tank 30% in just a few months. This reaction occurred to one of the world's most stable companies, not a risky penny stock. Absolute liquidity makes even the most valuable companies on Earth temporarily vulnerable to the irrational fear of the crowd. During the 2016 Apple crash, Buffett ignored the market's mood and relied strictly on the math. He used the market's lack of friction to quietly buy massive amounts of Apple while the rest of the world hit sell. That specific bet eventually turned into a profit of over $100 billion. This highlights the hidden power of the stock market's speed. The primary advantage of a frictionless market is the certainty that everyone else will eventually use that speed to panic and sell. Wealth is built by recognizing when frictionless speed has made the rest of the world irrational, leaving incredible assets on sale for those willing to do the math. When a stock price suddenly drops, human instinct takes over. We see red on the screen, assume the business is doomed, and start selling in a rush to avoid being the last one out. Look at Netflix in 2022. As subscriber growth slowed, the stock plummeted 75% in months. Critics claimed streaming was over, yet the shows, the platform, and the global reach were exactly the same as they were before the crash. The only variable that shifted was the market's mood. Because the business remained intact, the stock eventually recovered all those losses and climbed past $700 a share. This is why Warren Buffett doesn't run when fear drives prices down. He understands that short-term panic often leaves the value of a business untouched, creating an opening for a buyer to step in while others are focused on the exit. In high-speed markets, human emotion acts as a weight on price. It frequently creates temporary discounts on assets that are still performing exactly as they were before the headlines turn negative. If buying during a dip is so effective, why is it so difficult to repeat this strategy with a house? It's because of market friction. Unlike a stock trade, buying a house involves appraisals, physical inspections, bank financing, and weeks of legal paperwork. These hurdles slow every transaction to a crawl. There is also psychological friction. Homeowners anchor their expectations to what they paid or what their neighbors recently sold for. Even in a downturn, many will simply refuse to lower their price, choosing to wait years rather than accept a loss. This combination of bureaucracy and stubbornness acts as a shock absorber. It prevents the rapid price swings we see in the stock market, making real estate generally too stable to offer the deep, sudden bargains Buffett looks for. That stability is why Warren Buffett spent decades avoiding real estate. Yet, in 2012, he announced he wanted to buy hundreds of thousands of single-family homes. His plan was to use 30-year mortgages at historically low interest rates. By locking in a fixed payment while the value of money decreased over time, he was using housing to effectively short the dollar. What was the specific data point that finally convinced him to ignore the friction of the housing market? It was this equation, the price-to-rent ratio. It works like a PE ratio for a stock. You take the purchase price of the house and divide it by the total rent you could collect from it in a year. Historically, any result under 15 marks a market that is undervalued. At that level, the rental income makes the purchase price a deal. In 2012, many cities were sitting at a ratio of 12. In Phoenix and Las Vegas, it was below 10. This meant the entire purchase price could be covered by rent in just a decade without needing any increase in the home's value. The potential return was so high that it outweighed the slowness and headaches of property management. The mispricing was so significant that Buffett was willing to tolerate the friction he usually avoided. Looking at the market today, does that same opportunity exist? This chart shows the current price-to-rent ratio is now at 16. To put that in perspective, this is higher than during the peak of the 2008 housing bubble. By this metric, housing is more expensive today than right before the last major crash. Several factors are working against buyers. Mortgage rates remain high, and home prices are climbing faster than the rent landlords can actually collect. Because the math no longer supports the price, Buffett is radio silent on housing today. He isn't loyal to an asset class. He is loyal to the yield. He views every investment through the same lens. You calculate what an asset can earn, compare it to the price, and wait until the numbers make sense relative to the risk. While real estate is currently expensive, the stock market continues to offer openings because of its daily, headline-driven volatility. But the challenge is knowing the difference. How do you tell if a stock is a bargain or if it's falling because the business is actually failing? To find the answer, you need a specific filter. This is the same checklist Buffett used to spot Apple when it dropped 30%, allowing him to build his largest position while others were focused on the dip. You can download this free investment checklist at the link in the description. It contains the exact questions Buffett asks before committing any capital. Whether you are buying a home or a tech stock, a strict mathematical framework is the only way to ignore the noise and find a genuine bargain.